Hello, everyone, and welcome to today's webinar. I'm Hilda, Content Manager here at the DEO, and I'm so glad you're joining us today. We've got a powerful session lined up with a topic that's more important than ever: what's really impacting practice valuations in 2025. Whether you're planning to sell soon or just want to protect your equity, today's content will give you the clarity you need to make smart strategic decisions. Our presenter today is Chip, co-founder of Large Practice Sales. He's worked on over $1 billion in IDSO partnerships, and he's here to share what's happening in the market right now and how it affects you. So with that, I'll hand it over to Chip to get us started.
Thank you, Hilda. I appreciate it. And welcome, doctors. It's an interesting time today, given our turmoil in the economy and a stretched consumer. We're going to talk a little bit about what is an invisible dental support organization and why you should care, and the things that may impact your practice value in an invisible DSO partnership. The invisible DSOs are functionally groups which want to become your silent partner by buying anywhere from 51 to 80% of your practice for cash up front. You retain ownership in the balance and continue to lead your practice as an owner with your brand, your team, your strategy, and most importantly, full autonomy. The invisible DSOs do not want to attempt to micromanage your practice, and they do not want to homogenize it to fit some corporate standard. Instead, they want to invest in you and give you access to their resources to help your practice grow bigger, better, faster, more profitably, with fewer administrative headaches. And today, there are over 1,000 invisible DSOs in the US. They have been around for over 35 years. This is not new, and they are growing rapidly. In 2024, over $8 billion of new financing and capital was made available to the invisible DSOs to help them add great partner practices. And fortunately, the values today are still achieving records. In 2024, we did about $500 million of invisible DSO partnerships for doctors, including GPs and all specialties. And we did that in 27 states with 40 different invisible DSOs. So it's a great time to understand the potential value of your practice in an invisible DSO partnership and understand what they could mean for you or to you. Because once you have invisible DSOs in your community, and most of you do, they become fairly fierce competitors. Now, an invisible DSO partnership enables a doctor to achieve a higher value for their practice than any other type of transaction where you might monetize all or part of your practices. And the invisible DSO partnerships, if you choose the right partner, can generate significant generational wealth over time. And we'll talk a little bit about one of my favorite invisible DSOs and the wealth that they have been able to create for their 800 doctor partners over the last 7 years. But the invisible DSOs are all different. We consider 900 of that 1,000 invisible DSOs to be on our blacklist, and meaning we won't let them bid on our clients. But let's give you an idea of what kind of range of values that we have completed for our clients just in the last, call it 12 months. Lowest value deal was for a practice that was worth 2.9 million. It was a GP, and the highest value was also for a GP at $62.5 million. And interestingly, that was a single office GP, which dispels the rumor that you have to have multiple offices to get a high value, because you don't. There's a myth out there that values are down and that the number of bidders are down, and that is not true. If you know where to look, values are actually up. And the lowest value deal we did last year was at 6.75 times EBITDA. And we'll talk about what EBITDA is in detail. In our world, practices are not valued as a multiple of collections. Instead, they are based on a multiple of EBITDA, or operating profit. But you can extrapolate some of our deals, and we did over $150 million of deals just in the third quarter of last year, where the practices were valued at over 300% of collections. So it's a good time to be a dentist as long as you're growing. So in 2024, we achieved 10 times EBITDA for these types of practices across the US. Today, the most valuable practices are the pedos and pedo orthos because they tend to be growing, and they are the gateway to all dentistry. So, what hurts practice values? Number one, declining collections by far. Number two, margin compression. Many of you are experiencing higher labor costs, higher supplies costs, and not increasing reimbursement rates from your insurance payers if you take insurance. Losing an associate is not a good thing unless you have a whole bunch of them. And having sloppy and slow accounting does not help you manage your practice to make it its most efficient. And certainly, it does not help our process in finding a great partner for our client doctors. Now, to me, one of the biggest fears or things I would be worried about as a business owner, which I am, is what's happening to the consumer. The consumer at the moment is very stretched. They are in debt with more credit card debt than ever in history, and they're paying an average rate of 28% on that credit card debt. Which is not a good sign for those of us who are eager to get our patients to accept treatment. Now, the this is a little bit of an older chart, but some folks are still very bullish on the stock market. That may or may not be a good thing. But if you look at the global fear gauge, which is known as gold, it set new record highs about 2 weeks ago, and I believe it will probably go higher. And what it's telling us is that not just U.S. consumers are a little scared, but also global consumers. So consolidation is accelerating. Today, depending on who you listen to, let's call it about 20% of all doctors are affiliated with an invisible DSO or work for a DSO. The ADA believes that ortho is 22% consolidated, which means there's still lots of room to run. And today, the fastest consolidating practice types are oral surgeons. And the reason for that is because they have a recruiting problem. Of the 230 graduates from oral surgery residency in June of last year, about 140 of those went to the invisible DSOs, 25 went into public service, and the balance were fought over by the over 5,000 independent oral surgery practices in the US. It is very difficult to recruit an oral surgeon. And because of that, you've had a number of oral surgery practices decide to partner with invisible DSOs that can solve their recruiting problems. So, the key attributes for value in 2025 are very similar to what they are in 2024. But the in 2025, because so many younger doctors are eager for invisible DSO partnership, the invisible DSOs are becoming more selective than they were in 24, 23, 22. And as an example, in the $1 billion of these partnerships we've created in the last 24 months, $150 million of that were for doctors in their 30s. An invisible DSO partnership is not a short term retirement strategy. It is a great opportunity for a young doctor who's eager for growth to access the capital and resources to drive their growth faster than they could do on their own. And the good news is they can grow and retain ownership without taking any risk or taking on any debt. So if you're over 60 today, you should probably call me tomorrow and we should have a conversation because those young 30-year-old doctors are a lot more attractive to the invisible DSOs today than guys that are our age. And I say our age because I'm 65. And you can reach me at chip@largepracticesales.com. Pretty easy. And I respond to all of my emails. So the biggest story of 2024 is that we had multiple recapitalizations. Recapitalization is when an invisible DSO's investor and their doctor partners have the opportunity to liquidate all or part of the equity ownership that they kept as a part of their initial transaction. And in 2024, November 24, one of the invisible DSOs with which we had partnered, about 50 of our clients over the prior 7 years, completed a recapitalization at a value of over $3.8 billion. And keep in mind, some of our clients joined that invisible DSO when it was only worth $330 million. So the value of the equity ownership that they kept as a part of an initial transaction grew by over 10 times. So had you kept $2 million of equity in a transaction, that equity in November would have been worth well over $20 million. Not a bad trade for 7 years. Well, here's a chart of what their recapitalizations look like. First one in October of 17 at 330 million, second at a billion 250 38 months later, and finally at 3.8 billion in 24. One of the great things about large practice sales and the way we advise our clients is we've developed a pretty strong group of not only 35 team members who are focused solely on dental and solely on invisible DSO partnerships, but we built an advisory board, which has been very helpful to us. Dr. Andy Brown today, and we don't have it on there, is actually on the board of the American Dental Association. We completed a transaction for him several years ago, and he was one who partook in that amazing recapitalization. Admiral Davidson is probably one of the smartest guys on what's going on in the Indo-Pac region. When he was head of, or the commander of Indo-PACOM, which is based in Honolulu, he had 384,000 people reporting to him, including Army, Navy, Air Force, Marine, CIA, DOD, and private contractors. So he's an interesting guy that gives us a more global perspective, which is unfortunately important today. And we have Dr. Todd Jorgensen, one of the great implant doctors based in Phoenix. We partnered him with a great invisible DSO about 6 years ago. Mitch Olin, who is the co-founder of one of the largest invisible DSOs today with over 400 practices. Mitch retired and is on the board of a number of invisible DSOs and is generally regarded as the godfather of the invisible DSO industry. And finally, we have Bhavik Patel, who is an internationally known tax expert. And we have complicated transactions that require some tax wisdom. We always have him to call. Quick look at our team. We are a growing team and we are scattered across the country. We are headquartered in Dallas and we have offices in Florida and Arkansas. And we have people across the country that are working with our clients every day. And it is a great team. And again, it's nice that we're dedicated to one thing and one thing only, which is creating great partnerships for our clients with invisible DSOs. We don't do any doctor-to-doctor transactions. We don't sell any of our clients to traditional DSOs, and we only do dental. So here's a quick view of why investors are so eager for dental consolidation. It's a solid growing business. It survived COVID, and COVID may be the best thing that ever happened to the value of dental practices because even despite a shutdown, dental practices proved that they were very resilient. And today, there are a number of relatively new invisible DSOs that are backed by experienced investors that are eagerly partnering with great doctors across the country. And this gives you an idea of one of the older invisible DSOs and the returns that their doctors received. And obviously, as you can see, it was better to get in early and make 10 times the value of your equity in 4 years than it was to get in later and only make double the value of your equity in the last 5 years. Now, one of the things that COVID gave us was what we call the COVID earnouts. This is probably one of the most valuable features in a transaction today for a growing doctor. A COVID earnout basically says we're going to close on the value of your practice today, which will be dictated by its performance in the 12 months prior to the closing. However, we're going to give you a COVID earnout, which means we're going to adjust the purchase price on the 1-year anniversary of the initial partnership to pay you additional purchase consideration based on the growth of your practice in that first year after partnership. And then we're going to do it again at the end of 2 years and pay you for the second year's incremental growth in the EBITDA typically of your practice. And the nice thing is you get to benefit from your partner's resources to drive the value of your practice up and get paid additional purchase consideration for it in the 2 years post-closing. So an earnout is can be equated very simply here. Practice with $1 million in EBITDA was valued at $7 million initially. 1 year later, their EBITDA had grown to $1.2 million, so they got an extra $1.4 million in purchase consideration, which, by the way, if you structure it right, is taxed at long-term capital gains tax rates. Here's a look of what the ADA has to say from their most recent data. What's interesting is the size of practices. The average GP generates $830,000 a year in collections. Unfortunately, we can't help a practice of that size. The invisible DSOs are eager for larger practices. So pretty much the minimum size practice that we can help is going to have about 1.8 million in collections if they are a GP, and about 1.5 million in collections if they're a specialist. And ultimately, collections don't dictate value; profitability dictates value. So there are different views of the world. The ADA versus other data providers tell us that there are a lot more DSOs and invisible DSOs than the ADA thinks, and a lot more doctors that are affiliated with them. And this is just another data point to consider if you don't trust the ADA data. So, what is an invisible DSO? Well, there are functionally three different types of DSOs today. Number one, the branded DSOs, which you see on every corner. They may be PDS or they may be Aspen, and they typically own 100% of the practices that bear their brand. And they are going to homogenize those practices and micromanage them to fit their corporate standards. Then you have the invisible DSOs, the folks that we specialize in, which do not own 100% of any practice, and they do not rebrand their practice, and they do not homogenize them. But instead, they want to invest in great doctors that have been successful for whatever reason and help them continue in that successful path with their brand and full autonomy, not just clinical autonomy, full autonomy. In an invisible DSO partnership, the doctors are going to continue to make all of the major decisions in their practice, including who to hire, who to fire, what products to use, what labs to use, what payers to take, what procedures to perform, how to set their schedule, et cetera. Part of the reason the invisible DSOs are hands off is because they've got an owner doctor in there making decisions like an owner, not like an employee. And it's generally perceived that owner doctors will perform better than employee doctors. So, the invisible DSO model summary, and they are all different, keep in mind, but the doctor is going to retain ownership, and that ownership they retain may be held in one of three ways. It may be directly in their practice, such that they're getting a percentage of their practice profits paid to them monthly or quarterly. It may be in the parent company. And in that case, you're betting on the success of the group, not the success of your individual practice. And the third option is doctors can retain ownership both at the practice level for getting regular cash flow from their practice, and they can retain ownership in the parent to get the growth in the equity upside of their parent company. Now, the invisible DSOs are all different. Some are brand new. We helped form two brand new invisible DSOs using our clients as the platform practices last year. And when you can become a platform practice in an invisible DSO partnership that has the right investor, it can be very, very lucrative. In one of those, the investors had already started and monetized five other invisible DSOs, so they knew what they were doing. So it was a relatively low risk, high potential yield for our client to become the platform practice for that particular invisible DSO. One of the keys in trying to figure out who the right potential partner for you is to understand who is the money behind the invisible DSO that is financing their growth and choosing their management. Because remember, while management is important, money is more important because money trumps management. A lot of doctors are of the belief today that invisible DSOs or DSOs are all backed by private equity. That is not true. Private equity is certainly a large investor in consolidation. But today we have not only private equity, but also family offices. We've probably done $400 million of transactions in the last couple of years with family office backed invisible DSOs. And frankly, I like dealing with the family office backed invisible DSOs because they have typically one decision maker, which is typically the self made billionaire that created the family office, and you get decisions really fast. Whereas when you deal with the private equity backed invisible DSOs, a lot of it is management by committee and things take a lot more time. In addition, hundreds of the invisible DSOs are backed by doctors with bank debt. These are usually not our favorite invisible DSOs because they don't have access to the capital necessary to drive rapid growth and therefore create the size to create leverage with payers and leverage with vendors. which are important. In addition, today we have sovereign wealth funds investing in invisible DSOs. The country of Abu Dhabi, which happens to be the third largest sovereign wealth fund in the world after China and Norway, invested $1 billion in one of the 30-plus-year-old invisible DSOs about 2 years ago. And in addition, we have BlackRock, the world's largest asset manager with about $13 trillion under management, who has invested in 4 invisible DSOs over the last 30 months. So a lot of people are paying attention when big smart money starts getting into the dental consolidation game, which frankly has been very helpful in keeping the values up. And again, if you have a growing practice in the right geography and you're the right age, we are achieving record values for our clients. Not all of them, but a lot of them. Now, what are the benefits of partnering with an invisible DSO? Well, first of all, you got to choose one where you're going to have full autonomy. And full autonomy differs from clinical autonomy in that many of the DSOs and invisible DSOs will give their doctors full clinical autonomy, meaning you get to make all the decisions as it pertains to patient care. However, clinical autonomy does not give you full autonomy. You may have clinical autonomy and decide on patient care, but somebody else is making the decisions as to who to hire, who to fire, what products to use, what procedures to perform, et cetera. And that is not what we like. Our clients prefer to go with invisible DSOs that provide the doctor with full autonomy. One of the other benefits, obviously, is the cash up front. In our average transaction last year, our clients put about $6 million in cash in their pocket at closing, taxed at maximum tax rates today of 20% federal. Obviously, in 44 states, they also had a state tax burden to go with that. But the nice thing about the invisible DSO partnerships is they enable doctors to monetize a part of their life's work for cash at low tax rates. And it gives them the cash to diversify their personal investment portfolios, which is probably not a bad idea. And when you choose the right invisible DSO for you, because remember, they are all different, and our mission is to create a path to multiple bidders for our clients so that you can experience and see all of the different options that you will have. And those options may include practices with great cultures, and they may have practices that have recruiting resources. One of our favorite invisible DSOs has 30 full-time recruiters on staff at their headquarters helping their partner practices across the country recruit everything from front desk to associates. Other groups will have a dozen or more full-time in-house marketing people that will help drive new patients to their partner practices across the country. And one of the nice things that's happened really post-COVID has been that all the invisible DSOs will want to create a path to ownership for your current and future associates. Ownership is a great recruiting tool, and it's a great way to put golden handcuffs on team members or associates that you want to keep forever. And so the invisible DSOs will create that path to ownership, usually at no cost to you. And so that's an important element. And you also have the opportunity to access the expert management that are running the invisible DSOs to help you guide your practice in ways that are appropriate for you and are typically more profitable. Now, the size of the invisible DSOs gives them great leverage with both suppliers of everything from cotton balls to equipment to technology to AI to software to everything else. And they are typically paying 25 to 30% less on your basic supplies. They're paying oftentimes 50% less than independent doctors are for implants of all brands. And in addition, something that has become more prevalent recently is that the invisible DSOs are able to go to the insurance payers and get their partner practices reimbursed at higher rates than the independent dentists in their neighborhood might be getting reimbursed at. And this is changing. And if anybody tells you the insurance companies don't negotiate, just walk in with 500 practices in their coverage area. And guess what? They negotiate real quickly. Now, the invisible DSOs, while certainly we think they can be your friend because they're going to give you cash and help you create generational wealth, and they're going to take over banking, accounting, payroll, benefits, benefits administration, compliance, credentialing, tax, legal, IT support, and vendor and payer negotiations. And they're also going to give you a guaranteed exit strategy when you're ready to hang up the pliers, whether it's 5 years from now, 10 years from now, 20 years from now. You have a known exit strategy for that piece of ownership that you kept as a part of an initial transaction. Now, they can also be very powerful enemies. Quick story, ortho practice in Indiana. We partnered our ortho client with the invisible DSO that happened to own the five largest pediatric practices in town. And those five pediatric practices prior to that transaction had not been referring to our client. They were referring to the other four orthos in town. And my client just about doubled in size, and he was doing 7 million in collections when we partnered him with this particular invisible DSO. And today he's doing close to 15 million in collections, thanks in part to the referrals that he got from the five pediatric practices that were partnered with his new invisible DSO partner. So, if you're in the referral receiving business, you need to keep an eye on what's going on in your community because it can hurt. Specialists are really one of the fastest consolidating segments of dental practices today. If we go back 6 or 7 years ago, there were no oral surgery only invisible DSOs. Today, there are 17. And on top of that, you also have invisible DSOs that are eager for oral surgeons, which include the dental trifecta groups and the surgical trifecta groups. The dental trifecta groups are interested in pedo, ortho, oral surgery only in the same community. And the surgical trifecta groups are interested in oral surgery, perio, and endo in the same communities. And these groups will often bid higher values than the multi-specialty groups, but a lot of it has to depend on timing, location, growth of the practice, age of the doctor, et cetera. But the invisible DSOs in specialty are growing. My ortho slide there is actually wrong because there are now 13 ortho only invisible DSOs because the biggest of the ortho only groups acquired one of the smaller ortho only groups in the last 60 days. So, how fast are these groups growing? They're growing fast. Doesn't matter what kind of practice you have, whether it's a GP or specialty. There are groups out there that are growing very, very rapidly. And you've got to be careful with some of the rapidly growing groups to make sure that they have the infrastructure, the capital, the people, and the management to support that group. Because there have been some fast growing invisible DSOs that have stumbled due to growing a little too fast. Now, the invisible DSOs are on top of the new technology. If you're not using AI in your diagnostics, you're behind the curve because all of the major invisible DSOs, and for that matter, the branded DSOs, have all implemented AI in their diagnostic procedure. And certainly that's providing superior patient care, but I can tell you it's also adding to the bottom line. So if you're not using AI, at least in your diagnostic, you need to look at it. It's important. And that's one of the nice things about an invisible DSO partner is they're going to help you understand which technologies are most efficient that you want to adopt because they will have tried it out first on other practices within their group such that when you get to it, they're going to be able to help you implement it, help you operate it, and help you perfect it rather than you having to learn on your own. Now, the benefits for younger doctors in these partnerships are a little different than the older doctors because many younger doctors are eager for growth. They want to expand their existing office or offices, or they want to add de novo offices, or they may want to buy competitors or complementary practices in their region to help them expand. And that is something that all of the invisible DSOs are eager to support because organic growth is the most valuable thing to them when it comes time to monetize to a bigger investor. So, in many of the cases that the younger doctors, these doctors in the 30s and 40s that we partner with invisible DSOs, they're eager to access the resources of their larger partner, and that may be capital, it may be their in house real estate department, which can help them find, acquire, and build out new offices. And when you're young, you have the opportunity to see the value of that retained piece of equity that you kept grow exponentially. So it's pretty simple. If you kept $1 million in equity, and if that equity grew by 3 times every 5 years, which is not unusual, your $1 million in retained equity 15 years later could be worth $27 million. And we've actually seen performance better than this. And there will be plenty of examples that are not even close to this, but it's an option. Now, one of the fun things about the transactions for younger doctors is that you're going to have very creative structures. These invisible DSOs will bend over backwards to get the younger growing doctors, and the younger growing doctors will achieve higher values than static practices or practices with older doctors. Now, one of the interesting things is that there are many doctors out there who have partnered with traditional DSOs and maybe some of the invisible DSOs that are on the LPS blacklist. And so you have many of your associates who will say, oh, no, we don't want to do that. That's selling out to corporate. That's not why I got into dentistry. Well, the reality is once you have an associate who may be against a transaction, what we do is we put those associates of our client doctors on the phone with other associates that have been with clients of ours in the past, and they get to have a doc to doc conversation and find out that, you know what, when you join an invisible DSO, and if you choose wisely, it really is a great thing, not a bad thing. And certainly there are plenty of horror stories out there, and they are deserved horror stories because a lot of doctors are approached by invisible DSOs every day, and some of them are good and some of them are not so good. And frankly, doctors are smile experts, they are not transaction structure experts. So, frankly, we may be the biggest in the industry. We're bigger than the next five little advisors combined. But our number one competitor is doctors who seem to think that while they were in dental school, they mysteriously got an investment banking degree and they try and do deals by themselves. And when they do that, the outcomes are not particularly positive. So, number one myth is that you're going to lose your autonomy. The reality is you don't. And in our process, we're going to have our clients, long before they get married to an invisible DSO, talk to other doctors that have partnered with the particular invisible DSO that you're considering so that you can understand exactly what life will be like after partnership and get to ask questions like what changed, what didn't change, are you glad you did it? And most importantly, did your new partner do what they said they would do? So, big difference between clinical and full autonomy. So, the number one thing that doctors need to understand about their practice is what is their EBITDA. Now, EBITDA is pronounced in different ways, and EBITDA, et cetera. And there's about 20 different ways to pronounce it. And more importantly, there's about 100 ways to calculate it. EBITDA is calculated differently by every single invisible DSO. Some, for example, will give you credit for the differential between their costs, let's say, on clear aligners, because many of you are paying $1,400 for a lab fee for a famous brand clear aligner that I promised I wouldn't name. And there are many invisible DSOs that are paying $800 for that exact same lab fee. So you've got a $600 differential in their costs per case. And some of the groups, when calculating your EBITDA, will give you the benefit of that cost differential. Same thing in reimbursement rates. Many of the invisible DSOs are getting reimbursed at higher rates than independent doctors. And when calculating EBITDA, they may give you the benefit of those higher reimbursement rates when calculating your EBITDA. And so that's something that we know. We know how each of the invisible DSOs calculates EBITDA, and that sometimes can have an impact on whether we even show our clients to a particular invisible DSO. Well, we did a transaction years ago where a practice was using 4,000 implants a year. And we managed to find an invisible DSO that was paying $170 less per implant for the same implants our client was using. And you multiply $170 times 4,000 implants, that's a $680,000 increase in EBITDA or operating profit. And if you add $680,000 in operating profit to a practice that's worth 10 times EBITDA, you increase the value of that practice, and we did, by $6.8 million. We just happened to know the invisible DSO that was buying the right implants at the right price and would give the doctor credit for that differential in the costs. So it pays to have a little knowledge of who the bidders are and how they operate. So compensation is always an interesting discussion. Compensation on a go forward basis has a direct impact on the initial value of the practice, and different groups will use different compensation formulas. What I have here on the screen is a general range. All of these are negotiable, and ultimately when doctors understand the impact of future compensation on the initial value that they're going to get upfront in cash at long-term capital gains tax rates, they beg to work for $1 a year because it's a lot financially smarter to get your cash up front at 20% tax rates than get a higher salary or income over the next 5 years at 37% ordinary tax rates. So, understanding compensation and how that impacts initial value is important. And here's a couple of examples. This is a client in Florida. We had 18 qualified bidders for this group. This was a big practice that was growing, but it's interesting to see the EBITDA range calculated by the bidders varied by almost $1,300,000. And in this transaction, we got this practice over 10 times EBITDA, which means that the difference in the calculation of EBITDA meant a $13 million increase in their value. Second example, this was a relatively small practice and happened to be down the street from client number one, and the same bidder won both of these practices. It was a trifecta bidder. But again, look at the range of calculated EBITDA as calculated by the bidders. So, pretty significant differential. So, understanding the ways to calculate EBITDA and understanding how the bidders calculate it is very important. We see many doctors who are approached directly by invisible DSOs and make the massive mistake of letting the buyer calculate the EBITDA. Well, as you can imagine, if you're talking to only one bidder, they're going to calculate the EBITDA in their favor, not yours, and it could cost you millions of dollars. There's a couple other examples of what kind of multiples we've been able to achieve for growing practices recently, and the number of bidders is always important. Now, these are transactions that we've completed in the last year. And the collections on these clients range from 3 million to about 18 million. Average age of the doctors in the next slide was under 50. All of them had growing collections, 24 versus 23. And the deal structures range from 51% cash upfront to 80% cash upfront. So here's some of the multiples across the country. And again, it's all about timing. When you're in the right place at the right time, you can get things like 14.3 times EBITDA. And this was a very special practice with a doctor who was less than 40 years old and was doing 18 million in collections and growing like a weed and was a single office practice. So don't get hung up on having multiple doctors or multiple offices. Multiple doctors is better. Multiple offices is not always better. So let's have a discussion and we can talk about your situation. Now, if you don't have multiple bidders, you're making a big mistake because multiple bidders drives up values, but more importantly, it gives you the opportunity to understand who you will want to spend the balance of your career with. This is all about culture and lifestyle and vision and goals. It's not just about getting the highest bid. Certainly, it's nice to get the highest bid, and we want the high bidders in the game, but we want our doctors to experience what each of the invisible DSOs that may be bidding on them could be like for them in the future. Keep in mind, every one of these transactions is custom. These are not cookie cutter. And you can use an invisible DSO partnership as a great way to buy out a partner or give an associate ownership at an appropriate value. And you want to take 3 months off? No problem. That's doable. We did a transaction for a doctor who wanted to take a 1 year sabbatical, which he did. So all of these transactions are custom, and it depends on your personal situation and the invisible DSOs that we can find that will fit your goals. So in a typical deal, A practice might be worth 5 to 10 times EBITDA. We have not done any transactions in the last 3 years at less than 6.75 times EBITDA. But if you go back a couple of years, there were 5 times EBITDA deals done, but not today. Today, they are much higher. And you're typically going to get some portion of the value of the practice in cash, and you're going to get some portion in equity. And you're going to continue to lead the practice for years or preferably decades. And you're going to have an employment agreement that's going to pay you a negotiated amount. Now, the practices that qualify for high value invisible DSO partnerships will typically have an EBITDA of about $500,000 or more. The faster you are growing, the higher the value you will achieve. And your personality matters. One of the things that we have to convince our doctors is that certainly your numbers are the ticket into the game, but ultimately your personality and your vision and your plan for growth will get you a higher value. And so we do some coaching of our clients to make sure that they emphasize the elements of themselves personally and their practice. And doctors who are involved in organized dentistry are often very attractive to the invisible DSOs. For example, the doctor on our advisory board, Andy Brown, when we did a deal for his practice, he was president of the Florida Dental Association. And there were multiple bidders eager to partner with Andy because he was a unicorn. He was an orthodontist who was president of one of the largest dental associations in the country. And so the fact that he was involved in organized dentistry helped him get an extraordinary value. So, what are the ideal doctor and practice traits? Number one, the invisible DSOs want to work with doctors who are eager to have a partner, who believe in the upside opportunity of the equity ownership that they retain. Typically, a doctor should have a 5 year chairside horizon, or if you're a larger practice and you're no longer chairside, that's fine. And certainly, you can do transactions for doctors who have a shorter time horizon, but it will impact the value. But a lot of it depends on how much the owner doctor is actually contributing to the practice. So it's possible to do transactions for owner doctors who are not chairside, who may be able to leave in the very short term. Team turnover is an element that all of the invisible DSOs are looking at today, and groups that have or practices that have lower team turnover will ultimately achieve higher values than those who have high team turnover. Few owners is an interesting bullet point that I get a lot of questions on. And the answer is we've done deals for practices that had 10 plus owners, and those were very challenging, not only for us, but for the invisible DSO, because it's tough to get 10 owners to agree on anything. Having an updated facility and modern technology is important. You do not have to be on the bleeding edge of technology, and your facility does not have to be brand new, but it needs to be presentable, and you need to have at least technologies into the 2010s. And one of the ways that we create value for our clients is where we can identify gains and synergies via other practice clients we might have in the same area, such that we can give the invisible DSO the opportunity to partner with multiple practices in the same community. And when they can do that, we can often achieve much higher values for both clients or multiple clients. So that's one of the things that we do when we get a new client is we will contact every other dentist within typically 50 miles of them, not so much in Manhattan, but and say, hey, we have a great client in your region, and if you have a great practice, we potentially can partner you and our other client with the same invisible DSO and give them a reason to come to the neighborhood, a big enough bite, as we call it. And when we can do that, we get to increase values for our clients, both of the clients or multiple clients. We did, for example, in one Western city, 48 offices within 9 months with the same invisible DSO. And they were willing to pay up because they wanted to have concentration in that particular city. And our average client probably achieved a value 40% higher than they could have on their own just because of that strategy. So, why would you consider an invisible DSO partnership? Well, You know what? We are in risky times. If we have we're into the first quarter of recession measurement. First quarter GDP in first quarter of 25 was down. If we have a decrease in GDP in the second quarter, then we are officially in the much advertised recession. And if you have a practice where your collections decline, you all of a sudden become unqualified for a high value invisible DSO partnership. Now, if you think your area is economically resilient and your patients will continue to pay high dollars for high dollar procedures and your collections will not be impacted, then you don't have anything to worry about. Just keep growing, and the values are not going down anytime soon, except for practices that are not growing. So it's important to be ready for special situations, and it's important to understand what could happen in your community. Now, values change weekly, believe it or not. As an example, we had an oral surgery client in Florida, and we managed to get that practice $52 million because we knew a group that wanted a practice like theirs to become a platform for a new invisible DSO. And so they got about a 30% premium over what they would have gotten going with an existing invisible DSO. Couple of years ago, we had an invisible DSO that had partnered probably $300 million of practices with us or vice versa. And they said, hey, we told our board at the beginning of the year we would be in Arizona and Colorado, and we're not there yet. Do you have any great practices in those two states which we could potentially close by the end of the year so that we can keep our promises? And we did 1, 2, 3 practices in Arizona and Colorado in the fourth quarter. And all of those doctors got a 25 to 30% bump in value just because they were in the right place at the right time. And we did something similar for oral surgeons in the Northeast a couple of years ago. Same situation. Promises made had to be kept. Now, tax is very important because ultimately all that matters is the net that you get after paying Uncle Sam and your local governor. And so structuring these transactions for the best tax outcome is something that's very important in what we do. And in the last $1 billion of these transactions, 94% of the cash received by our clients was taxed at goodwill rates, which means 20%, instead of ordinary income rates, which is what would be on the 6% tangible in that example. And so you want to make sure you understand how tax allocation negotiations are structured because it's almost important as the overall purchase price. Another thing to remember is that you will not be subject to the Obama tax. That applies to the stocks in your brokerage account, but it does not apply to selling your business. Now, if you own your own building, which many of you do, congratulations. You have two great options in an invisible DSO partnership because you are now going to have a AAA credit tenant in your real estate. And therefore, the value of your real estate goes up because of the quality of your tenant. And today, there are over a dozen real estate investment trusts eager to purchase practices or to purchase the real estate of a practice when it's occupied by an invisible DSO or a DSO. And so the value of your real estate goes up, whether you want to monetize the real estate concurrent with a practice transaction or whether you'd like to do it later. But in the meantime, you're going to get to collect rent from a AAA credit tenant for the next 15 years, and it'll be up to you what you want to do with your real estate. But an invisible DSO partnership is a win. Now, the LPS blacklist. This is always a touchy subject because we have invisible DSOs that call us and want to know whether they are on our blacklist or not. And the answer is it's pretty easy, Mr. Invisible DSO. Have we showed you any practices recently? And the answer is if you're on our blacklist, we are not going to waste our clients' time nor our time asking an unqualified practice to look at or bid on our clients. So the blacklist changes on a regular basis. We have some groups that have come off the blacklist recently because they have gotten multi-$100 million credit lines, which means they now have the ability to grow and create value for their partner practices. And we have other groups which are now on their third CEO in 2 years that are on the blacklist because until they stabilize their management, we certainly wouldn't want to partner any of our clients with an unstable managed invisible DSO. Now, do it yourself risks. You really want to have a bidding war. It's going to add for value, and it's going to create the opportunity for you to consider all of your options and figure out what's the right partner for you long term. Also, keep in mind that in all of these transactions, you will be getting some form of equity ownership, and you want to make sure that that equity ownership is structured correctly because there are many groups out there that will try and give you equity that is what I call the bag of marbles, meaning it's a piece of funny paper that may have no ultimate value and may have little, if any, upside. So, how these transactions are structured is very important. Same thing with leases. We see doctors who have tried to do it themselves and end up in leases where they have functionally rendered their real estate unsellable because of clauses within the lease that gives the invisible DSO the opportunity to buy the real estate at a predetermined price, which is not a good thing. So don't try and do it yourself. Here's some example. We always tell doctors, hey, if you've been trying to do it yourself and you have bids in hand, send them to us. We'll look at them. And if we can beat them net of our fee, then we'll have a conversation. And if we can't, we won't waste your time. But in 99% of the cases, when doctors come to us after having negotiated their own deal, we are getting them far higher values after going through a bidding process. Now, there in any business that's growing and rapidly consolidating and has billions of dollars sloshing around in it, you end up with shady promoters, as I call them. So there are lots of groups out there that are saying, well, we're interested in partnering with you, but we're not going to give you any cash, but we're going to give you magic paper. We're going to give you equity in our parent company. And you're not going to get any cash and you're not going to get any cash flow, but you're going to get magic paper. And you don't want to go there. You don't need to go there. So you need to fully understand exactly who your potential partner is. You need to understand your structure. And I urge you to use a specialist advisor who all they do is dental. I always get a chuckle out of the little groups that are not only trying to do dental, but they're trying to do vet and med spa and ophthalmology and cardiology and behavioral health and whatever is the hot topic today. The reality is we have 35 full-time people and all we do is dental and all we do are invisible DSOs. And that gives you a level of knowledge and experience. And most of the little guys, although many of them will neglect to mention this, are also getting paid by the buyers. We do not. We are only paid by our clients, the doctors. So our sole interest is to ensure that our doctors are getting the best deal at the highest value with the right partner for them. We are not paid by the invisible DSOs, which in part is why we can create bidding contests with 6, 10, 12, or in last year's case, 18 qualified bidders because many of the invisible DSOs won't deal with the little advisors because they won't pay them a fee from the buy side because they think it's unethical. And you can make your own call on that, but we do not get paid by the buyers, only by our client doctors. Now, the most commonly asked questions that we get are what's going to change and what won't change? And the answer is we're going to help you answer those questions because you're not only going to meet with the senior management of the invisible DSOs, you're also going to talk to other doctors that have joined the invisible DSO. And so you're going to get to ask those questions what changed, what didn't change. And in any case, you're going to be the one who's making the hiring and firing decisions. And you'll be pleased to know that your team members are going to end up with better benefits, typically at lower cost than what they have today, always. Because the invisible DSOs are not just partnering with you, they're partnering with the great team that you have built. And they want to make sure that they are happy and stick around forever. Now, which we talk a lot about multiples and 10 times EBITDA, and the reality is 10 times EBITDA is not easy, but certain practices today can get 10 times EBITDA, and in some cases more. But it's going to take an EBITDA of over $2 million in most cases. You're going to need to be in a desirable geography. Now, the desirable geography is a definition that changes pretty rapidly. Last year, our highest value deal was done at over 11 times EBITDA in Vermont. And Vermont was not on anybody's high value geography definition a year ago. Younger doctors is good. Growth, again, is really important. And finally, let's talk about what the future could look like. What I'm showing you here is a chart of veterinary practice multiples. And as you can see, we saw about a 35% decline over a 2 year period in veterinary practice multiples. Am I saying this is coming for dentistry? No, but veterinary is similar in its consolidation pace to dental. And the point is that multiples may stay high or multiples may be at risk. I don't know, but this is the only data point I have to compare it. So, what I urge every doctor to do, and I appreciate you taking the time to hear my monologue today, but we would love to have you contact us if for no other reason to look at our website, largepracticesales.com. And I am happy to have a conversation with any doctor to talk about their personal situation. And there's no obligation and it's confidential. And the good news is, I can confidently promise you that you will learn something in our conversation. And these are typically a 20-minute, what I call a discovery call. We want to learn a little bit about your practice and help you understand what might be possible in an invisible DSO partnership. And then, if you're interested and qualified, we will go through your numbers and tell you exactly what your EBITDA is, and therefore exactly what is possible for you in an invisible DSO partnership today. And we have many doctors who have become clients just in the last couple of months where we've been looking at their numbers every year. And they've now decided now is the right time for, in some cases, over 5 years. So don't be bashful. We're happy to go through your numbers and help you learn what may be possible from a value standpoint. And in a lot of cases, we're able to point doctors to elements of their P&L where they might be able to improve their EBITDA today and in the future, and potentially increase their value in the future. So please contact us, Chip at largepracticesales.com, or you can call us, or you can go to our website. And thank you for your time. I appreciate it. And have a great week.
Thank you so much, Chip, for your time and sharing such incredible insights with us today. And thank you all for joining us for today's presentation. Just like Chip mentioned, if you have any follow up questions or want to learn more, don't hesitate to reach out. You can scan the QR code that's on the screen to connect with the team at Large Practice Sales. Thanks again for being here, and we'll see you next time.